Hi, I'm Patu from freefincal. Today, let's take a look at ICICI Blue Chip Fund. Many of you may know what I'm gonna say at the end of this video, but you can share the video to somebody who is invested in something like this, an active large cap fund such as this, and so on. So this fund was started during the 2008 crash, and it had a mandate of investing in 20 large cap stocks. Throughout its history, it's been a style pure fund of large caps, but it had a clause of increasing the number of large cap stocks once the AUM went above 3000 crores, I think. And it was able to manage 1000 crores, I think, 1000 crores, but it was able to manage at about 20 stocks up to 3000 crores. And after that, it started increasing the number of stocks. Today, it holds only 69 stocks. So, what essentially happened with this fund was that as long as it was a focused blue chip fund, it was able to provide reasonably good returns. But then, as the AUM increased and it started increasing the number of stocks in the portfolio, the outperformance vanished. And particularly after 1st February 2018, when the heterogeneity in the stock market, where the mid caps fell down, the Nifty moved up, when the heterogeneity increased in the market, this fund was not able to provide that alpha anymore, outperformance anymore. So I'm going to show you some returns of lump sum and SIP returns. Well, lump sum you can have a look at. Lump sum you can have a look at in the article. I'll just show you the SIP returns because I'm not going to waste too much time saying the obvious. So that's the asset allocation history. As you can see, the blue is the large cap component. It's been pretty much almost 90% large cap for pretty much whole of its history, which is good. Of course, it started its history as ICICI Prudential Focused Equity Fund. Then it called itself Focused Blue Chip Equity Fund, and now it's just calling itself as a blue chip fund. So that's the trailing returns, the lump sum returns. The red ones are the outperformance. So you can see that the fund, both the regular plan and the direct plan, have not outperformed the Nifty 100 for the last 1, 2, 3, 4 years, and in the case of the regular plan for 5 years. And you can see that the gap above that, there is some outperformance. The fund has bet the benchmark, but you can see that the extent of outperformance is kind of diminished down the line. And this is the SIP performance, and again you can see that both the regular plan and the direct plan has not bet the Nifty 100 or the Nifty 50 for the last 1 year SIPs, 2 year SIPs, 3 year SIPs, 4 year SIPs, and 5 year SIPs. And in particular, the regular SIP over 6 years has failed to beat the benchmark, over 7 years has failed to beat the benchmark, over 8 years has failed to beat the benchmark, whereas the 6 year and 7 year direct plan has bet the benchmark. That's the difference of the commissions being removed from the NAV every day before it's declared. So again, there are two lessons in this video. One is get rid of your active large cap funds. They're just not making any sense anymore. If you want active performance, move to an aggressive hybrid fund. That'll at least give you some kind of lower volatility for sure. If you don't want aggressive hybrid, you can move to a Nifty index fund. The second lesson is, please get rid of regular funds. That's the impact of commissions over the long term. So that's about it. ICICI does have a good history, but how it will perform in the future, it's going to be anybody's guts, but that's a long enough period for underperformance. So I think it's time to quit such active large cap funds. Thank you. Bye bye.